Good afternoon, everyone, and welcome to today's webinar hosted by BDH Sterling. Today's webinar is going to be aimed at financial planners here in Australia and how we can help your clients make the right decisions with overseas pensions. So today's presenters, the first elephant in the room just to address is that Georgia Baker is unable to attend today's webinar. So myself, Daniel Ash Wentworth, will be stepping in her place. Hopefully I can do as adequate a job. I am qualified as a pension transfer specialist in the UK and have been living in Australia for 8 years coming up now. And I've got with me today my co-presenter, Steph Mills. Steph is also, like myself, from the UK and been here now for 5 years. Steph is a pension transfer specialist, and as you can see there, holds a certificate in pension transfer advice and the diploma in regular financial planning in the UK. So a very British feel to today's webinar in terms of hosts. Just for general warning purposes, this is for financial professionals only, that we will not be delivering any personal advice. It will all be general in nature, just to be mindful for everyone on today's webinar. In terms of what we'll be running through today, so hopefully you'll find it fairly comprehensive. We'll be covering off the types of pensions, what is transferable and what's not transferable. We'll be talking about CUROPS and the significance of that anagram. We'll be talking about considerations for transfers, what benefits potentially come with transfers, and then also giving you a bit of an insight into some of the recent changes that have taken place in legislation that impact looking at these transfers, but also some of the proposed changes that are upcoming in the coming years. We'll also talk about the impact of drawing from a UK pension, and then also again talking about some of the transfer options. We'll end today's session with a bit more of what we do for our fellow professionals and advisors here in Australia, and then talk through and show you a bit of what the process would then look like if you were to engage yourselves. And then we'll finally end with a Q&A session. So just with questions, if you do have any questions throughout the presentation, please feel free to enter them into the Q&A box, please not the chat box, just so I've got it all in one area for when Steph and I address those at the end of today's webinar. So on that note, without further ado, I will pass over to my colleague Steph to take you through the first part of today's webinar.
Perfect. Thank you, Daniel, and hello, everyone. Alrighty, so the first part of the webinar today will talk through the types of UK pensions and why your clients may consider transferring these types of pensions. So there are two main types of pensions in the UK: defined contribution schemes and defined benefit schemes. Defined contribution schemes are also known as money purchase schemes. These are very much like superannuation here in Australia. They are funded by contributions by members and employers, and you have a wide choice of how the money is invested in these types of plans. The way that they're funded in the UK is also partially through tax relief. And if you've got clients that are higher taxpayers in the UK, they will receive higher levels of tax relief on their contributions going into pensions of this type. When they're able to access the benefits, at the moment is age 55, they'll have options of drawing a lump sum, which is 25% of the fund value, and then flexible income options with the remainder. This is quite different to super, where they can actually have years where they take no income and years where they can take quite a lot of income. On the alternative to defined contributions, we have defined benefit schemes. So these are also known as final salary schemes. They are very valuable schemes in the UK. And because of this, the way that we approach the advice on these types of schemes is slightly different. They are pensions that provide guaranteed income for life. They're generally indexed and they provide for the member and the spouse. So on death of the member, typically they'll provide 50% of the benefits to the spouse for their life too. Employers fund all of the risk with this type of scheme. So they manage and bear the investment risk throughout the time of the defined benefits. They also don't cost anything for members once they're put into payment, and they would receive that guaranteed income for life, as I mentioned before. So the income is based on their salary, usually their final salary, the length of service in the scheme, and an accrual rate of the scheme as well. So to give all of that up, all of that guaranteed income, safeguarded benefits, you can apply to the scheme to have a cash equivalent transfer value. So this is essentially a transfer value that's the capital value of the sum of those benefits at that point in time, and they're generally guaranteed for 3 months. So when you receive one of these, 3 months is the time to have all of the advice prepared, and for clients to understand the recommendations, and if there's positive recommendations to transfer, for that to get underway in that 3-month period as well. So not the longest time period that we work within in this type of advice, and certainly is one that's quite tough to meet the deadlines on that, but we try as much as we can. For this type of advice as well, you do need a advisor who is UK licensed. This is where we can come into play, and advice is required when the CETV is over £30,000. Okay, so with pensions that can be transferred into superannuation or elsewhere, defined contribution plans. So these schemes can typically be transferred away. Private defined benefit schemes as well. So this is schemes such as Shell, public sector funded defined benefit schemes. So if you've got clients that have worked for their councils back in the UK, they will have a local government pension scheme, and these are transferable too. And generally QROP schemes are transferable as well. There are schemes that can't be transferred. So the UK state pension, which is equivalent and like the age pension here. So a government pension that's put into payment, and once you have that income, it's guaranteed for life, not transferable. Also, public sector unfunded defined benefit schemes. So these are schemes such as NHS, civil service, teachers' pension schemes. They will provide those guaranteed income options, but they will not give your clients any right to transfer. If you've got clients that have defined benefit schemes that folded, became insolvent, they would have gone into what's called the Pension Protection Fund. So this is a fund in the UK that does pay members of defined benefit schemes where the employer hasn't been able to. Typically between 90 and 100% of those income options there, and you will not be able to transfer from that type of scheme either. And annuities are not transferable too. So to look at the transfer options for your clients, we would be looking to bring them into Australia into a QROP. So this is a superannuation that meets special obligations from HMRC to run as a compliant fund here in Australia. And typically it means that it cannot provide better benefits than those you would expect to have in the UK pension environment. Some of the main ones that you've probably heard of are that members cannot be under 55, and you cannot hold any direct residential property, and no income protection plans. And that's because you can't do any of those things in UK pensions. QROPs are really designed to receive pensions that have come from the UK, and they are for people that live in the country that the QROPs is. So in our world, we're looking at clients that live here in Australia that will have an Australian QROPs fund. There can be some hefty tax charges if the QROPS is not compliant, or if there's reasons for the transfer not to be approved, or even retrospectively as well. One of the main ones is the overseas transfer charge. If you have a client where they do not retain their tax residency in Australia up to 5 full UK tax years after the transfer, they could see a tax applied on the whole transfer of 25% of the value. There are ongoing reporting obligations on QROPS funds for 5 to 10 years, depending on residency. And there's also a couple of options on the type of product. There's one retail scheme here in Australia, and the alternative is to have a self-managed super fund that runs as a QROPS, has the application made to HMRC to run it as a compliance QROPS. There are also some compelling reasons why transfer might not be right for your clients. Typically, this is when we look at defined benefit schemes. The starting assumption for any advisor in the UK is that a transfer out of this type of scheme is not in the client's best interest. And this is a stance that the regulator, the FCA in the UK, always expects us to start from. Some of the reasons of this are loss of guaranteed benefits, taking on costs that are not there with the scheme that they're transferring from, members not being comfortable or not understanding that they're taking on transfer risk and investment risk that was not there in the previous scheme. Loss of protections as well. So we talked about the pension protection fund before. Transferring away from a defined benefit plan, you would lose that protection of having 90 to 100% of the income for life paid if anything happened to the scheme. In this overseas environment that we work in, UK to Australia, but also defined benefits as well, we do see that there's scams. This is why we've had the rule of using a UK regulated advisor when the CETV is above a certain level. There's also a lot of increased scam protection in the UK, which we'll talk about in a little bit too. But really, when we're looking at the options from UK pensions, particularly defined benefits, it may be that retaining that or transferring that is in the client's best interest, and it will also always depend on personal circumstances. There can be some really great reasons to look at transfer options for your clients. They do live in Australia. Australia is their long-term residency, and simplifying funds and bringing them into Australian superannuation is often what clients are looking to achieve with this type of advice. And when we look at currency, this is always a big compelling reason to look at this as well. Having funds in local currency, being able to remove that ongoing fluctuation of having income paid in sterling. When we look at where the exchange rate's been recently, it's been over $2 to the pound for several months now. 10-year average has been 185 to the pound, but we see it fluctuate a lot, as you can see in the graph here. And it's always one that is a big reason to start looking at this type of advice when clients want to remove that ongoing currency risk. Some other considerations for transfers, simplifications we talked about before, control of investments, having funds here in superannuation, along with everything else that they've got in Australia, not having to deal with things in the UK ongoing. Tax efficiency, there can be some real benefits of using superannuation as a retirement vehicle, alternative to UK pensions. Moving away from the UK rules, these are always evolving, which we'll touch on. One of the big ones that's coming into play over the next couple of years is around UK inheritance tax. And if you have clients with large defined contribution schemes, then there can be some rationale to move away as quickly as possible from those rules becoming burden on those funds. Estate planning and legacy. Having funds over here in Australia, if your clients or their beneficiaries live in Australia, can be compelling. But also, if you do have clients with beneficiaries in the UK, sometimes there's some options of having the estate planning there can be a little bit better too. Just really depends on the client's situation. So I'll talk through some of the changes that have happened in the UK space and touch on a couple in Australia as well that do affect this type of advice that we provide. One of the big ones that came in a few years ago, but we are seeing this affect more and more clients as they go through the transfer process. And if any of you do have clients that we've advised on and are going through this implementation, this might be one that resonates with you. So the UK pension providers do have increased due diligence on them now after the scam and trustee rules came into play in 2021. You'll see that a lot of clients, when they're undergoing transfers from a UK scheme to another UK scheme or to an overseas scheme, will be referred to a guidance helpline called Money Helper. And this is all around and making sure clients understand that they're doing is the right thing and all around scam avoidance, but it does make the process longer. You'll see increased timeframes. This is one that we are seeing come up more and more, that a lot of clients will be referred to the guidance helpline to make sure that their understanding is there for the provider to be comfortable that they can do the transfer out of the scheme. In April 2024, we saw the removal of the lifetime allowance. So the lifetime allowance has been into play for a long time, since 2006. And it means that clients will be able to accrue pension benefits in the UK up to just under 1.1 million, as is there, that they can look to take benefits or transfer overseas without incurring any tax charges. So when you have clients that have funds above that, generally speaking, they will be taxed on the excess. This was replaced by the overseas transfer allowance, the lump sum allowance, and the lump sum and death benefit allowance. And what we've seen with this replacement is that we've actually had some more generous allowances, because the overseas transfer allowance is the same amount as the lifetime allowance, and the lump sum allowance is a quarter of that. So we now have two allowances that have given us a quarter more availability than we had before. When you've got larger funds, we can use both of these options to bring out funds in a tax efficient way, if that's the best option for clients. In April 2025, where you do have clients with bigger balances, lifetime allowance protection was available, fixed protection 2016, which meant that up to 1.25 million rather than the 107,300 there. You'd have clients that would have that personal amount available to them as a tax-free protected amount. You're no longer able to apply for that protection. So any clients that don't have that already will have the lifetime allowance that's noted there. Domicile rules have been replaced by residency tests. So where you have clients that have large UK assets, this might be something to look into, potentially take some estate planning advice if it is something that could affect clients, but just something to familiarise yourself with, that this is changing, and it will be statutory tests of residency, and there can be a residency tail as well, which does bear effect on inheritance tax from the UK perspective. So some things come into play here. We've got the total super balance, which is increasing from 1.66 to 1.76 million to bring in a 360,000 non-concessional contribution using Bring Forward. So that's been a positive increase on there. We've talked about the inheritance tax that will be coming into play in the UK, but essentially this is something that has always been outside of scope in the UK, has been pensions, and it's made them quite tax efficient for legacy and estate planning. Pensions, unused pensions, so these are your defined contribution plans. So the ones that do have a fund value that haven't been spent in the UK, they will be coming into somebody's estate for inheritance tax purposes, and any funds above the nil rate band, which is currently £325,000, will be taxed at 40%. There can be some options for a spouse band as well, but it's going to depend on your client's personal circumstances. In 28, we are expecting the normal minimum pension age to increase from 55 to 57, and this will also see the CUROPS member age increase to 57 as well. So there will be a period where clients are going to be affected by that if they're nearly 55, 56 at the moment, 54, 55. That will see that this will affect them being able to not bring their funds into CUROPS as quickly as they were previously able to at 55. But this is to be in line with the UK state pension, so there's a 10-year difference between the normal minimum pension age. So this will be the age that your clients can take benefits from the UK, lump sum and income options, and look at the CUROPS transfer. So I talk about the options of potentially leaving funds in the UK, what that looks like from a tax perspective, and then we'll look at the transfer options and how that can potentially bring funds into superannuation. So if you have clients and they leave funds in the UK and they draw pension income, the UK and Australia is inside of a double taxation agreement. This means, generally speaking, that your clients will get taxed in the country that they live, which is Australia. Sometimes they will get taxed at source in the UK. You can go through a process of reclaiming that, or they can apply for a nil tax code to have that paid gross. But ultimately, Australia as well, they'll be taxed on pension income from the UK. There are options to apply a UPP deduction. If there's been any contributions on pensions, they can reduce the taxable amount of that component as well. Lump sums are slightly different. So lump sums, we talked about clients having that option for 25% as a tax-free cash payment from those defined contribution plans. As residents in the UK, they are tax-free. In Australia, when you draw them directly from the scheme in that way, they generally will contain an earnings component from the date that they arrived in Australia, generally speaking, and that is taxable in Australia at marginal rates. So lump sums are not generally tax-free when you draw them directly from the UK pension schemes. When we look at bringing funds into Australia through CUROPS, there are different components of how the transfer is made up. The first component being the growth component. Generally, since your clients have arrived in Australia, this will be the applicable fund earnings. So the applicable fund earnings is the taxable component of any pension transfer, and this is taxed at 15% from superannuation, otherwise taxed at marginal rates, depending on how that is brought over. And that will be paid directly from the super scheme as well. So growth is always taxable at 15%, applicable fund earnings being the name of that component. For balances that your clients have bought, that have accrued in the UK before they've come over to Australia, this is the non-taxable component, generally speaking. This forms non-concessional contribution cap. So this is how we use the NCC limits to bring through funds that have been accrued prior to arriving in Australia. So 120,000 per year or bring forward 360,000. Larger funds for this component will be split up over multiple years. And we can also use lump sums to reduce larger balances as well. So we'll look at transfer options for clients that are over 55, clients that are under 55. So once a personal recommendation has been made to either retain the benefits or to transfer the benefits, this would be typically how we would structure strategies for your clients on the Australian CUROPS if that was the recommendation made. So where clients are over 55, they can bring funds into Australia straight away. So we'd look to consolidate funds in the UK if that's the right option. And then we would look to buy dollars, again, controlled by your clients. We can do that in the UK. Then we'll break up the components to limit the tax to the growth component at 15%. So this will actually go into a separate pension sometimes, and then that will come into superannuation from that pension and taxed at 15%. In this example, we're looking to take a lump sum as well. So the lump sum will be of the balance after the growth has been removed. So $740,000 is what we have here. 500,000 was the growth. So we've got 240,000 left. At that point in time, that is tax-free. So that is why we can release a lump sum in this example of 60,000, 25% of that balance, and it's not taxable because all of the taxable component has been removed and tax applied in that first large payment of 500,000. Tax on that component is 15% rather than marginal, which would be the alternative. So with the balance after the lump sum, we've got 180,000 left. This will come through as non-concessional contributions using the bring forward, and that will come and be added to the AFE that's already been sent to the CUROPS. So you have the gross balance there added to super, and then the accountant or the fund will arrange the tax payment when that's due of the applicable fund earnings. There can be some good planning options for clients that are under the age of 55. Really depends on personal circumstances, because if they're under 55, you can't bring funds into Australia straight away. But there are some options that we can look at. So we can consolidate the plans, we can buy dollars, and we can invest the funds in the UK. Generally speaking, we have options for Australian dollar investments and sterling investments, really depending on what's best. And then at 55, 57, when the QROPS is set up, start the strategy option of bringing that funds into Australia in line with the non-concessional caps.
Technical difficulties. I'll take us through a bit more of the business-to-business services we can offer. So what BDH Sterling can offer to fellow financial planners here. So first of all, BDH Sterling is a dual license or has dual license advisors. So advisors that are qualified to provide financial advice in both the UK and Australia. And in-house, we also have UK pension transfer specialists and can therefore deliver UK compliant advice documents. So, obviously, to fill the gap for yourselves who may only be Australian qualified, we can meet those requirements that Steph's talked through earlier in the presentation. One of the important things around our business service that we deliver is that the client remains yours. We see this as an outsourced service that you're obtaining, and that ultimately the relationship will be for yourselves to continue post this transaction or outsourced service. Obviously, part of the benefit for yourselves is being able to offer this through ourselves. It does mean that you're expanding your offerings to your existing client base, with a fair few of us Brits being over here, or Australians that have built up these UK pensions from work over there, and it also should hopefully help you enhance the client retention and satisfaction in terms of these additional services that you'll be able to offer through ourselves, and of course from a bottom line point of view, it should mean that there's an opportunity for yourselves to increase the funds under management and retain control of those monies once they are transferred across to Australia. BDH Sterling assumes all responsibility for the pension advice, so it does mean that there's no compliance risk for yourselves as an Australian planner here. And of course, we'll continue to provide technical support services through the team, such as Steph, Georgia, myself, and any other UK pension transfer specialists that work within BDH Sterling. We can always go through the strategies and what solutions are available for those under 55 or those that don't have the ability to transfer, such as Steph has touched upon today. And we do have the functionality to explore currency control and investment options even within the UK, for clients that are unable to transfer immediately and may want to look at doing something with those funds in that interim period before an onward transfer can be explored. We do not outsource any of our services, so all of our paraplanning and administration team is all in-house, that would be working on any case that you may introduce to BDH Sterling. And of course, the UK pension transfer specialist that you're working for will always be your main point of contact throughout. So, any questions can always be directed for them, and they'll have their finger well and truly on the pulse throughout any of these transactions that you may engage us for. And hopefully it'll be a seamless experience then for you and your client, through that process. So some of the reasons why engage BDH Sterling for this outsourced service and this business-to-business relationship. We're a chartered firm in the UK, so higher accreditation than many others. We've got pension transfer specialists based throughout Australia. So obviously Georgia, who was meant to be here today, is over in our Sydney office, and there's a couple of other UK pension transfer specialists located over in Sydney, and we have Steph and a number of the other advisors here in Perth that are UK pension transfer specialists in our Perth office also. We have the defined benefit permissions, so some providers or some UK regulated advisors may not actually be allowed to provide the defined benefit advice, so there needs to be specific certificates attained to be able to deliver that advice. And we can provide the QROPS product advice. So should you or your licensee not be comfortable with providing the initial Australian advice to set up a QROPS superannuation fund, that is something we can also offer in addition to the UK advice at no extra cost. But again, that's an optional piece, and I'll come on to where that sits in the process in a moment. As a firm, we have 16 years experience in UK pension transfers across to Australia. It was very much the bread and butter of where this business was established. So the experience there is well and truly vast. we have advice provided in-house for both Australia and the UK through our global offices. So our head office, global head office, is still in the UK. So we've maintained that sort of nucleus over there, but also with a large employee network now within our offices here in Australia. Our Google and Trustpilot reviews, as you can see in the top right-hand corner, are extremely competitive, up towards that high level of 4 stars. And we can provide advice in other areas, such as Australian Super in the UK, if you've got any clients that are requiring sort of specialist advice in that area, or even if they're looking for personal tax advice, we've got a sister company, BDH Tax, that may be able to fill that gap for you and your clients that do have assets worldwide. So in terms of what that process looks like, if you and your client did want to engage yourselves to explore their transfer options, so the first thing would be to hold an initial discussion with one of the pension transfer specialists within the technical team. There's no cost involved with that initial discussion, and we treat that more as a qualifying session to understand, is a transfer, potentially a viable option to explore, and then be able to allow us to indicate to you and your client what costs there may be involved throughout that process, so they can make an informed decision as to whether they want to engage BDH Sterling and that pension transfer specialist to continue with the process. At that point in time, we'll share with you and your client our compliance documents. I appreciate there will be a bit of duplication to what you may have got them to complete with the fact find, but unfortunately we still need to get the client to complete our own versions of these documents to ensure we meet our regulatory requirements in the UK. But more than happy if some of that can be pre-populated through fact finds they've completed on your behalf to make it easier for the client from an administrative point of view. Then we will undertake pension research into the UK scheme, and then once we've obtained that UK pension information, that's when we can then prepare our UK pension transfer analysis report with full transfer recommendations included in there. There is then the optional service for yourselves. If the client is under the age of 55 or their balance is larger than the contribution caps, we can deliver ongoing advice for those clients for their monies that have to remain in the UK, and that can be potentially explored to be held in GBP or AUD depending on their preference, prior to then the ability to bring the funds across to Australia when they're 55 or potentially 57 with those proposed rule changes coming in the UK. For clients that are over the age of 55, then we can do transfers for straight away, where you can arrange the transfers of those funds according to the recommendations that have been proposed and the fees quoted within that advice document. I mentioned a moment ago there is an optional service for you and your clients if you wish for us to provide a limited statement of advice for the initial establishment of the CUROPS product and which of those products is going to be most suitable. We can provide that as a complementary piece to the UK pension transfer analysis report, and then allow you guys to provide the investment advice and any ongoing advice from that point there on moving forward. And that brings the end of that brings to the end of that process and also to the end of today's webinar. So we can now move on to any questions and answers that have been sent through that I'll bring up today. So we'll just see. First question, nice and simple. Will this session be recorded and be able to be assessed afterwards? Yes, it is being recorded. I believe it will be emailed to any of the participants. It won't be going on our YouTube channel though, because it's for financial professionals, but we will send you it directly so you've got access to that. Correct me if I'm wrong on that point, Steph.
Correct.
Perfect. I'm just going to move across my screen so I can just access some of the questions, so you can just get mine and Steph's lovely faces for a moment. So I'm just pulling up some of the questions here. Bear with me all. That one off. Done. Please, again, if you do have any questions, please feel free to put them into the Q&A chat, as I mentioned there. So we've had another question come through here, Steph. So if I just... so one of the questions here, do you have to be a permanent resident to use a CUROPS, or does it apply to temporary residents on a bridging visa?
It's a good question. One of the issues with temporary residents is being able to access the benefits from super. So you may be able to establish the cure ups on the temporary visa, but you won't be able to draw any super income until they're permanent.
Perfect. Good to know. I've got a question here, Steph. Did you mention there is an industry fund in Australia that meets the CureOps rules? What fund is this? Thanks.
Yes, there is. There is only one, and it's called the Australian Expat Superannuation Fund, Retail Cure Ops. Only one available, but they do all of the hard yards with the Cure Ops reporting that is on the funds for a significant time after the transfers. So some good options to look at that, as well as the self-managed super fund for clients.
On the CureOps, can you draw down on these funds from a CureOps?
Yes, so normal superannuation rules apply. So if you have a CureOps fund and you're meeting the condition of release rules, then you can access these funds as you would with normal super. Just be aware that when your funds are in the member payment provision period, generally 5 years after the transfer, they do have the UK rules on them as well. So the way that you draw benefits does need to be in line with the UK rules. We can help you with that, discussing that, but generally speaking, it's all around the type of withdrawal that you make rather than being able to limit any withdrawals.
So this one might be linked to some of the content in today's webinar, but if you take the tax-free cash lump sum from the UK pension, will it be taxable here in Australia?
It really depends on when you take it. If you draw it directly from the scheme and you haven't removed your applicable fund earnings, the growth via a CureOps transfer, then if your clients have been here for a while, generally they'll have a taxable component because that applicable fund earnings will be contained in the lump sum, therefore due at marginal rates of tax when they draw it. But if you've removed it with the applicable fund earnings and taken it pretty much straight after that, then no, there shouldn't be any more additional earnings accrued to be taxable.
Perfect. One simple question here. What balance would make a CureOps SMSF worthwhile?
I mean, that's probably a better one for you, Dan. You work on the Australian side of what's reasonable for an SMSF.
Yeah, we'd always say typically starting from sort of 500,000 would be sort of, generally speaking, but of course there might be other considerations to factor in, but that would be sort of a guide I would suggest for a CureOps SMSF. The question has just come in as well here, Steph. Where a client may have 2 or 3 schemes with one provider, do you view this as one scheme or assess them individually?
Yeah, interesting question. It depends on the research. So if you've got a client, they've got 3 policies under the same scheme, but the information is the same for every single one, it's just different values and so on, we would class that as one. But if it's the same provider, but 3 very different schemes, we would class those as different schemes.
Perfect. So hold on. We're going to read this question. So just one come in, might have been answered. So do you work alongside SMSF accountants here locally? My client has a CureOps already and a second person about to turn 55. I manage the investments locally. Yeah, I'll answer that one. So yes, we do have actually an in-house SMSF accounting department here at BDH Sterling. So if you are looking for a trustee amendment as such to be able to, or adding that client as a member, potentially that is something we can assist you with. So yeah, if you want to get in touch with us post today's webinar, we can get you in touch with the SMSF team to quote you the fees involved for that, and then allow you to remain as the advisor on that CureOps SMSF moving forward. That's all the questions we've got so far. I might just give us a 30 seconds or so in case there are any final questions to come in today. Otherwise, we will call the end of today's webinar. As I've said, if there's any questions that come up following today's webinar, feel free to send them through to us. We do have, I should probably have shared the final screen for you all just so you can see our contact details. So bear with me and I'll put that up on the screen just for everyone to view now before I let you all go for the day. But if you do have any other questions that you haven't been able to think of today or think of post today's webinar, then please do feel free to send those through to us accordingly. Oh, we have just had one come through, Steph, while I'm saying all of that. How do you notify HMRC?
HMRC is generally paper forms, depending on what you need to notify them on. So if this is in relation to the CureOps reportable event, so after the transfer is completed and then reporting back to HMRC on things like starting a pension and so on, that's generally a paper form that gets sent to HMRC. I do believe that they will accept that on email, or it can go in the mail. And then if you're applying to HMRC for your self-managed super fund to become a CureOps compliant fund, again, it's an application form to HMRC.
Perfect. So yeah, I've put on the screen there. Hopefully everyone can see that again. Our offices around Australia, the email address for ourselves is inquiries@BDH Sterling, and you can see the numbers for the UK and Australia. So if you do have any specific scenarios or clients that you wish to get in contact with us, please do feel free to contact us through one of those mediums. And otherwise, I think that was the final question. So we'll wrap it up there. So thank you all for giving us your time today during a working day, and for those in WA and Victoria, I should say, off the back of a long weekend. And we look forward to hopefully hearing from you and working with you in the future.
Thanks, Dan. Thanks, everyone.
Cheers, everyone.